Hello, Sector Watchers. Welcome to the 6th episode of Sector Spotlight on Tuesday, the 5th of November. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength, and or rotational analysis. My name is Julius de Kempenaer, and I'm your host for today's show. With me are Zach, who's handling the technology, and producer Rachel, who will help me with questions from the audience and make sure that I stay on schedule. We're trying to make this show interactive, so we encourage everybody to participate in discussions or ask questions. Email and social media are open 24/7, but the preferred channel during the show is the live chat. We will keep an eye on that and possibly answer as much as possible while we are on air. And here is what we will be looking at today. Because it is the first show of the month, we'll be going over the monthly performances of the asset classes and sectors and clearly see if we can get a clear outlook for those. We'll have a break as usual. We'll have some live questions. And if there is any time left, I would like to dive into the rotation of commodities. Let's move on and get some RRGs and some charts on the screen. On the left-hand side, you'll see the performance of the asset classes that I'm usually covering in my blogs and here on air. Over the last month of October, S&P up 2.2%, closely followed by commodities at 2.1%. And then here is already the benchmark that we're using for that portfolio. That is the Vanguard Balanced Index Fund. That consists of 60% equities and 40% in bonds. So these two are actually making up this benchmark. And then the other asset classes that we're tracking are real estate, corporate bonds, high yield bonds, government bonds, and here is the US dollar, which was very weak actually over the last month. That translates into a rotation, and I'm using a daily RRG here to pretty much match what we're seeing on the left-hand side. So if you look at the performance numbers in this column here, you'll see that they match that period here. So we got SPY on top. If we quickly browse through those asset classes, then we'll see that equity SPY is inside leading. That's one of the few asset classes in there. It's rolling over, but it's on the daily chart, so on the weekly things will look much better. We've got commodities that is just getting in there. That's an interesting asset class. I want to take a better look at it later because it seems to be coming to life again. Here's your benchmark, and then we got real estate, which continues to deteriorate as it's been doing over the last few weeks. And then obviously the fixed income related asset classes are having trouble. They're underperforming right now. We got the investment grade corporate bonds inside lagging. The worst seems to be over on a daily scale, so it's turning up a little bit, but these are the weakest asset classes at the moment: government bonds, high yields, and then here you got the US dollar. If we look at a similar image for the sectors, I have prepared that for you, so we can go neatly over that. So here is the birth chart for the 11 sectors, and here is the accompanying RRG sorted on performance. And what we'll see here is that healthcare has been the strongest sector, followed by technology, and a very good month for financials, actually. We got communication services close to the benchmark, and then all the other stuff like industrials, discretionary materials, etc., they are all underperforming. So the October performance was largely carried by healthcare, technology, financials. Luckily enough, these are pretty heavyweight sectors. So in terms of breadth and participation of number of equities and volume, this was very good. If we look over, again, here is the 23 trading days. Please pay attention when you want to match this screen on your own system in your own StockCharts account. Make sure that you use 23 days look back on the RRG and 24 days look back on the perf chart. It has to do with the alignment and the beginning or the end date of that series. It's a little bit, some series start at 0, some start at 1, and then you got these differences. But as you can see, the numbers match. He's got 5.13 here for healthcare, and we've got the same here. Also beware that I'm looking at the 31st of October as the latest date. So that's the month end that we're tracking right now. Quickly going over these, see if there is anything. So healthcare now really getting into the leading quadrant, technology getting their financials in there, turning over, but still strong. Communications, and here this is actually a pretty good example. So you see that the numbers are good, but the rotation is down. And I often get a lot of questions if something is, most often is something is in leading and then it shows an underperformance or a negative performance, and people say, how is it possible that something is inside the leading quadrant and still showing an underperformance? Well, the reason is that RRGs are looking at trends, not necessarily at performance per se. And what you see here is a performance number, and what you see here is a relative trend. So they don't necessarily match up. And here you see that the relative trend for communication services is negative, but the performance over the last 23 days, well, I was going to say is better than the benchmark, but it is actually like spot on with the benchmark. Okay, now as it is the end of the month, I want to go over quickly and see if we can find some discrepancies on the monthly charts that we are having. And here I have a chart list which shows the asset classes monthly charts. And I be careful because this is the first, when we did the first show, we had that issue with unadjusted versus adjusted, and I decided to bring that back because when you look at these really long-term charts, that makes a whole lot of difference. So let's quickly start here. US dollar, I think that this trend is still going higher. There is a series of higher highs and higher lows in play. That low is still higher. We're still way above that previous low. So for me, the US dollar is still in an uptrend. Now, if we move on to, and here is commodities, it doesn't seem much, but if you look at the RRGs, you've seen that the tail of commodities is actually improving rapidly, and it seems to be, holding above that 20 level and starting a new move towards, this is a resistance area which is way above 25 US dollars, which is in percentage terms quite interesting. So maybe this is the revival of commodities. We're not sure yet, but we'll have to see. Now here is a situation where adjusted versus unadjusted absolutely makes sense to bring into the game. This is the adjusted series. This means that the dividend payments are included in this price series. The one on the right is unadjusted. So the dividends or coupons maybe for corporate bonds are not included. You can always have a big debate on what is better or worse, etc., especially with these high yielding or fixed income type stuff. But I like to bring in the unadjusted because that is what is in people's minds. That is what people have actually traded at in terms of levels. So in total return terms, corporate bonds are still in an uptrend. In price terms, they are sort of moving sideways. So you're not gaining anything on price. You're earning money on the coupons that are coming from these high yield bonds. We got something similar in government bonds. This is probably a more familiar chart. And what I think is striking here is that this is the adjusted chart. So that includes the coupons. And that is, well, we made an all-time high a couple of months ago. If you look at the unadjusted version, that is what people have actually traded. You will see that we are actually testing that 114 top dating back to 2016, which is now a very heavy resistance level. So I think that well, either a real rally in bonds will occur when we can cleanly take out this high here, or when we fail to do that, we get a decline in that. So that 114 level in psychological terms, I think is really important to keep an eye on. Now here is LQD, that's investment grade corporate bonds. Again, adjusted, very nice uptrend, but in unadjusted in price terms, this one has just broken out. And look at that trading range that we had here. It's very pronounced. This is what is in people's heads. That's why we got these lows in that 110, 112.5 range, and we got the highs here coming in between, let's say, 122.50 and 125. And that is now taken out and is holding up above that 125 level for a couple of months already. So I'm keeping an eye on these corporate bonds to jump higher if that level holds and we're taking out these recent highs around 130. Well, here is the S&P 500. I'm not going to spend too much time on this one because everybody is talking about it. You've all seen it. We are at all-time highs. We're pushing higher. I kind of come up with a negative story for equities for the time being. Now here is real estate, and again, this is a high dividend-paying sector, and that is why looking at these unadjusted chart is so important, because you can clearly see that it is getting into trouble around the highs of 2015 and 2016. I think that real resistance level is that, well, maybe even if you just simply put that thing on here, I think this is sort of the resistance level that we should pay attention to. So that's like 88, between 88 and 90. That's probably where the meat of the resistance is. We're currently above that. If it holds up, that is very good. If it doesn't, if we fail here, then we can go all the way back down to 70 US dollars. Well, that's a different story than you would come up with, a different narrative when you look at a chart like this, where the decline is like $80 and that is your breakout level. Well, you know, this is what I mean with the difference between adjusted and unadjusted. I don't know if there is a right or wrong, but I do think that it is something that you definitely need to be aware of, because that dividend effect can be pretty big on certain sectors. So if we go to these were the asset classes. We're 1642. Okay. Let's do this. I am actually going to put Rachel to work now and start in the commercial break that we're having. And then when we're back, we're going to talk about at least one question that came in, and I will check what's came in during the show. And if there is time left, then we'll deal with commodities, but we're going to go over the monthly charts for the sectors first. We'll be back in 30 seconds.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
And we're back. So no questions in the live chat box. That's disappointing, people. I mean, come on. I'm sure people must have questions. And, you know, there are not many people that ask them questions. I think everybody's afraid to do that. I don't know why. We got one question. Rachel, can you help me with that?
Yeah, I sure can, Julius. The question is from Dan, and he asks, Julius, it would be greatly appreciated if you could clarify how to best use the percent change color scheme on the right side of the table in conjunction with the tail color scheme on the left side.
Yeah, good question. In terms of the answer, I don't know if there is a best way to do it, but what I can do is clarify what that column actually means and what it does. If you look at that percentage change column here, that is actually the percentage change, in this case for the sector, over the length of the tail. So when you load it up by default, you get a 5-week tail. So the performance that you see here is the performance over 5 weeks. So financials gained 7.4% over the last 5 weeks. What I like to do is play around with the sorting of these columns. So if you look at, you know, the percentage change and you sort it in a declining order, then you can see that actually industrials was the strongest. And then when I toggle through the list, I can immediately put the last 5-week performance over what I see on the RRG's tail. So what you see here, XLI +7, Insight improving, rapidly going towards leading. Financials, 7.4 already there. this is the nice stuff, you know, everything above, and that white banner here, that is your benchmark. So everything above that white bar, or white row, I should say, has been outperforming the benchmark over the last 5 weeks, and everything below has been underperforming. So you see, you know, everything above 4.3 is above, everything below 4.3 is below. So that gives you a very quick handle on how the relative trend, as you see it here, has been matching with the performance, and we can make it relative by just comparing it to the benchmark. Now, watch this. This is 5 weeks. If I change the tail length, say to 10 weeks, you see that my order has changed, because now financials was the strongest, and then energy is second, industrials, technology, etc. So by using by combining, I should say, the percentage change column with the symbols and the tails, and the tail is actually the quadrant in which it is on the RRG, you can build your picture on performance, relative performance, and relative trends. So I hope that answers the question, but that is how I do it. I'm not sure if it's the best way to do it, but I think it's a very handy feature. Okay, we got that out of the way. By the way, you can obviously do that by, you know, do it on daily. If you do it on daily, and now we have 10 trading days. Now this performance is over 10 trading days. And if you then, let me because it's actually pretty cool. Bring up another RRG. So here's the daily. That's for US sectors. So let me get US sectors weekly. What I often do is say 5 weeks here, 5 weeks on the weekly, matches 25 days on the daily, 25. And then you set the performance, and you'll see how that is changing here. And you can get a handle on how, let's say, financials, so that's 7.4 and 7.6. There's a difference because this is weekly, so that's a rounding error. But you can see that this move here on the weekly is actually this on the daily. And using those percentage changes, you can get a better handle on what's going on. Anyway, let's quickly get back to these monthly charts for US sectors, because they are super interesting to keep an eye on. So here are my monthly ETF charts, the regulars, and here are my monthly ETFs unadjusted. This is SPY. We all have seen that. We know that. Let's kick off with materials. Well, here you see that there is not too much difference between adjusted versus unadjusted. And what I see here is, let's say, an uptrend that is in play out of the 2019 low, and we're about to try and break above that previous high. The unadjusted, the psychological level we are now testing. Adjusted, we are already above it, but stay with me, that last bar here, we should ignore that, because that is only 2 days and a couple of hours old. So in terms of monthly bars, we're just below that breakout level, and we'll have to see what happens there. But the uptrend for this year is still in play. We go to communication services. Again, not too much difference, adjusted versus unadjusted. We are playing around with 52 US dollars. I think that is the level to watch, the area around 52. If we can break that, that'll be very, very good news for communication services. So keep an eye out on a break of 52 US dollars for communication services. Energy, that's the one with that big long tail on the outside in the improving quadrant. On the monthly, actually, it's not very, very visible yet. I mean, it's been doing okay over the last couple of weeks, so this is a very sharp rally. But in terms of monthly trend, I think that we're sort of captured just above support in the 55 area. Again, look at the difference between adjusted and unadjusted. I think that 55 on this chart here really shows up as a support level, while 55 here is sort of nothing. That's like, much more like 40, 44, 45 is where the lows are. And this one here is 52. But in the last couple of months, that's going down. We're holding up above support. We'll have to see if that relative improvement will manage to pull this monthly chart out of the doldrums. Quite frankly, if there is a big rally in the S&P 500, we'll have to see whether energy can capture that, can keep up with that. Financials. Now here is where you see a difference between adjusted versus unadjusted. This is adjusted. This is where you included all your dividends. And financial stocks notoriously have pretty high dividends, especially because the, well, not anymore, but the real estate sector used to be included in that. There's still pretty high dividend paying stocks inside financials. And this is what you see in price. So here it looks as if we're breaking to new highs. As a matter of fact, it looks as if we already broke to new highs back in 2017. Well, I've got news for you. That is not the case. The high in financials was set in 2007 at 38 US dollars. That is the level what people have in mind. If you doubt what I'm saying, talk to people who bought banks or financial stocks in the first half of 2007, and they'll know exactly at which level they bought that stocks, and they're probably still holding on to that. Anyway, nevertheless, the most recent price action is improving. We're taking out some intermediate highs here, that's for sure. And especially if we can break above this high here, which is around 30 US dollars, then we're going to go pretty much all the way up to that 38 level. And then it's becoming very, very interesting to see what's going to happen there. So I'm very positive for financials, but it is by a mile not breaking to new highs. Industrials. This is a stock or a sector that I really like. It has been pushing against that resistance level. In adjusted terms, and again, this is only a couple of days old, so we should ignore it. But it's very difficult to ignore such a nice break. And it looks as if we're going to do the same here on the unadjusted version, because I think that the real resistance is here at that 79.50 area, because this high here is 80.96, or I should say 78.50, 79. This is just one intra-month high at 18.96. Let's say $81. I think the real meat of the resistance is just below that 80 level. And again, just like here, it's hard to ignore such a nice move that we see now. However, in monthly terms, we have not broken out yet. We have to wait until this bar completes. But for sure, I'll be keeping an eye on this one in the next few weeks, because I do think that if this one is going, then it'll go very fast. And this is a very cyclical sector. And this could be one of the sectors driving the market higher when, let's say, maybe financials are flattening out or technology is flattening out. This is one of the sectors that can actually take over the lead of those other sectors. Technology, again, there's nothing negative to say about technology. Again, adjusted versus unadjusted, I think that the unadjusted version shows support and resistance much nicer. We can see that this pullback that we saw at the end of 2018, it landed, right smack in the middle of this. Again, I believe that or the peak here was the area around 58, and not necessarily that peak at 65. That was like intra-month, and then we closed here, and then the next month. So I like to look at the meat of that area here, because that's almost a year of price action that we're looking at. That is a serious level. And you see that it's been tested, almost to the dollar in that decline in 2018 before it rallied. We don't see that here. We don't see that in the adjusted version where you include your dividends. So from a psychological level, that was very important. We're still going higher. I really do like this sector. We may see some setbacks over the next few weeks because it's been driving the market higher, but that's okay. There's no problem there. Staples, one of our defensive friends. But it was one of the defensive friends that has been taking care of the move in the S&P to levels where we currently are. This is one of the driving sectors that actually put the S&P toward its all-time high and breaking it. And we're now seeing technology, industrials, financials taking over the lead from consumer staples. So I would say thank you, staples. But for now, we're done, and we're going to look at other sectors that are a little bit more cyclical and have higher betas. Because I keep track of that beta spreadsheet. It's actually doing pretty well. It was sort of a small experiment that I played around with, and it started working. I mean, so I'm definitely going to keep an eye on that. Real estate. Here also, where is that? Here is my unadjusted real estate. And I look at the there you go. Here is the unadjusted version, which broke out very nicely. And here you see the adjusted version where you see the dividends included. So the support level that I'm watching, because real estate is now actually rapidly going down. It's losing a lot of relative strength. If you look at the RRGs, it's moving inside weakening and rapidly deteriorating. In price terms, I am looking at support in the area around $35 US. That is the high that we've seen in 2016. And again, I'm talking about the meat of that resistance area. That was 34, 35. We've got 1, 2, 3, 4, a lot of bars, 5, 6 monthly bars that are being putting highs in that area. I think that is the old resistance area that we can now expect to become support. So that's 35, 36. And actually on the adjusted chart, that is in this area. And quite frankly, that is nothing. There is no reference point here, while there is definitely reference point on the unadjusted chart. Moving on to utilities. Again, that's like staples. This has been one of the sectors that brought us to where we are now. This is one of the sectors that helped the S&P rally to these levels. And now the technology, the industrials, financials are helping the S&P push higher and break its resistance levels. This is not a bad chart, folks. This is a very good chart, but it has had a massive run. And I think that we could see declines toward 57.5 without a problem, just as a corrective move. There's nothing negative about it. It's just a normal correction that I can see happening here in utilities when it's handing over the lead to those other sectors. And then here is healthcare. That is our one before last. That's still having trouble with that high. We could see some form of a triangle here. Again, this last bar we should ignore. It's hard when it's on the chart, but I'm still going to try. So what we should conclude here is that healthcare is still in a consolidation area. 90 and 90 in the middle, so 93, 94 on the upside, 90, 86 on the downside. So it's consolidating, and we pretty much have to exercise some patience here to see where it will break out, because it will eventually break out. The question is on which side. And then finally, we have consumer discretionary. Again, one of the sectors that helped us get here. It's running into trouble. We're having issues with that 125 area. We're sideways around 120. Not much going on. We'll have a lot more, or other sectors that are much more interesting right now. Dude, that was really quick. That was 30 minutes gone. This was the 6th episode of Sector Spotlight. Thank you for watching, and please keep those questions coming and make them come so we can make sure you and I are on the same page. I hope to see you back next week, same day, same time, every Tuesday, 10:30 to 11 a.m. Eastern. Thank you.